So this whole idea of adjusting entries, the point of it is if you do not do them, your financial statements are not going to be accurate. And so this table basically summarizes how your financial statements will be incorrect if you do not do a type of adjusting entry. So in the first row, we see type of adjusting entry is deferred expenses. This is when the cash payment is first and then you have a expense that's taken later. And so the adjusting entry is a debit to expense, which will increase the expense, and a credit to an asset, which will reduce an asset. So if you did not make this entry, what is the impact? Your income statement, your expenses are going to be understated because as we see here, the expense is debited, which means that you're going to have an additional amount on your income statement for expense, which you would not have had if you did not make this entry. So if you did not make this entry, your expenses are going to be understated, meaning you did not include an expense that you should have included. And if you do not include an expense that should have been included, your net income is going to be too high. It's going to be overstated. And so that is kind of the impact on the income statement. So the other side of this is this reduction in asset. So if you don't do this adjusting entry on your balance sheet, your assets are going to be overstated because when you credit this asset here in the adjusting entry, you're reducing your assets. So if you don't do it, your assets on your balance sheet will be overstated. And assuming your liabilities are unchanged, if you're overstating your assets, our equation is assets equals liabilities plus equity. So if your assets are too high and your liabilities are unchanged, if your assets are overstated, that means your equity is going to be overstated. And this is related to this net income being overstated because as we learned, when net income flows into the balance sheet, it's captured in ending retained earnings. So if your net income is going to be overstated, you'll have too much ending balance retained earnings, and therefore your equity will also be overstated. So that is the impact of not doing deferred expenses on your financial statements. And so we can go through the rest of these. If you do not include the deferred revenue, which is basically you're reducing a liability and you're creating revenue, or not creating revenue, let me correct myself, you're recognizing revenue and you're reducing an unearned revenue liability. If you don't do that, your revenues will be understated because this revenue that you should have included would not have been if you didn't do this adjustment. And if your revenues are understated, your net income is going to be understated because liabilities are overstated because you did not reduce the liability with this debit here. Then that means since assets, which is we assume unchanged, if your liabilities are too high, that means your equity is going to be understated because assets equals liabilities plus equity. So if your liabilities are greater than they actually should be, that means your equity has to be artificially reduced to balance out the equation. So this is also related to net income being understated because again that flows into ending retained earnings. So equity should be higher because the ending retained earnings should be higher because the net income should be higher. Accrued expenses, again, we go through, we see that an expense is not included that should be. So our expenses again are understated, our net income is overstated, and the liability is understated because we basically needed to create a payable here, but if we didn't do the adjustment, that payable is not there, and so our equity would be overstated and our liabilities would be understated. And then accrued revenue, again, we are adding or recognizing revenue that we need to through the adjustment and adding a receivable asset. So on our income statement, if we fail to do this, the revenues will be understated, the net income will be understated, and our assets will be understated because we should have a receivable, but we don't, and therefore our equity will be understated because we didn't include an asset in what the company owns, and so therefore we're understating what the business owners own because we didn't include something that the company actually has rights to.